Okay, listen up. We're gonna go over 12 of my pointers, and this is basically what I'm gonna call the common language of the trading markets. And I don't care if you're in futures, stocks, bonds, or Forex, and a lot of this stuff actually applies to other markets like real estate, retail, budgeting around the house, pawnbrokering, or brokering anything where basically you have to buy your supply or invest in something and then be able to assess the risk involved, okay, and work with some kind of landscape. You know, what's the landscape of reality that you're in? If you were in craning, okay, as soon as you step foot into a crane to start operating, you're in a landscape of reality, right? Or if you were a rock climber, or if you were just camping and hiking, or you were adding on something to the house, or raising a family. There's all these rules, okay? And that you have to understand the language of before you can do it adeptly. And a lot of people are starting from scratch. And other people have an advantage where they have peers that are able to be there and relate to their, beginnings, their lack of understanding, and basically translate all of the quote unquote conversation that's occurring in that landscape of reality, whatever it may be that you're applying yourself to and investing yourself in and taking risks. By the way, risk isn't just financial risk. There's a lot of risks out there. And the thing is, though, is that, to the fool, there are no risks. There's only advantages. There's only opportunities. There's only jump out there and get it. But in time, with enough experience, you realize that risks are in every step of anything. Actually, they may be low risks, they may be high risks, they may be frequent risks, they may be infrequent risks. So, in regards to these markets, okay, basically what I'm trying to do is I'm trying to say, okay, this is like a committee meeting. Okay, kind of imagine like the crazy UN, okay, and they've got all the crazy world leaders there. There's a few good ones in the bunch, but and then they're going to talk about, oh, this is what we should do with people, and they're going to use their sly games and all that. But basically what you're trying to do is understand the conversation in its context there in that temple of doom. And so how are you going to do that if you don't understand all of these languages, right? So you've got all these humdrum Joe Blows and Nancy Marys in there, and you don't know a thing about what they're saying. Well, what you need to do is you need to get the translator in your ear, right? And then you get the translation of everything, which can be distorted. Absolutely. Those things can be distorted out of true context. But in markets, Are there things like that? I would say that the news can be contorted. That data can be contorted, and it often is. I would say that absolutely there's not a strident attempt to inform everybody what the underlying principles are in economics, such as the central temples of banking doom and how those operate, and the tenets of socialism and how those wind up, and on and on and on. And in the markets, the actual markets at the exchanges, there are things like algorithms that can do things that people can't do so well. You need to understand their input on the market data. There are things called dark pools, which do not they don't occur in futures markets, but they occur in the stock markets. And so basically what that means is that you have your depth of market in the futures. Okay. Well, the stock version of that is called the book. Hold on. What is it? All of a sudden I forget the name of it because I haven't traded stocks in a while. Not day trading, but level 2. Yeah, it's the book level 2. It's the book in either one. They call it the book in either one. And they call it the book because originally in the days of the early exchanges, there was somebody that had a book. And so they would keep track of all these orders that traders and investors were giving to these bookkeepers. And so when the price would, basically price had to move out of necessity. So if I've got an order to buy 150 contracts or shares, and I've only got 50 at the next price increment to sell, right? Then I've got to raise the price up to the next price increment, and there may be only 50 there. So in order to fill this order now, I've got to raise the price up even higher, up to the next level, to get the thing completely filled. So I fill everybody's orders on those 3 price increments and the buyer that came in to buy those. So it's a little bit, I guess, the book is something like what you would see with betting. They have the bookie, right? But it's not the same where the bookie doesn't actually move prices around. There's not a market like that. So on the platforms, you'll see the level 2. They'll call it the level 2, and that's for stocks. So it works just like the dome. It's the same thing. It's the book, okay? And you've got your limits on the offer and the bid side. The orders are all in there. They're falling off. They're being put on. And pulled off by computers and people manually doing it with computers because they have algorithmic. Basically ATMs, algorithmic, kind of like, think of it like you've got like a hand, a poker hand, okay, and you're trading with these algorithms. So rather than just simple, buy and sell, you've actually got these programmed algorithms that do certain things until it's carried out or until you cancel it and you've got a series of them. So you can pull one out and lay it down, or you can pull out multiple ones and lay it down. And of course, these are orchestrated all throughout the entire, the universe of stocks and bonds and all of these things. Some institutions have their algorithms in everything. Some just focus on some things. Some people are not concerned about everything. They're just focusing on the one market that they're in, whether it's a stock or otherwise, and they've got their algorithms to play with. And then some people don't even have algorithms, and they focus on multiple markets, or they focus on one. So in the stock market, they have something called the dark pools. And this came along when the algorithms came along. And so what happens is these algorithms are made to sense volume. So the more volume that they detect coming out of the exchange data where trading is occurring. So trading occurs in the exchange. And how does that work? Well, orders are exchanged, right? Sellers and buyers, right? And it can be for any reason you want to sell. It can be for any reason you want to buy. That's not anybody's business. Just like when you go to a store and they're going to broker products to you between their sellers who sell stuff to them, right? So they're the broker in between, and really those stores are exchanges. And so they're just helping facilitate the exchange between many sellers and many buyers. Okay. So this goes on in these exchanges. There's nothing ridiculous about it. There's nothing mysterious about it. But the thing is, though, is that let's say you're in an institution or you're just a private investor and you've got a big order to put on, right? So maybe 10,000 shares, 50,000 shares, whatever, it's your business. But there's algorithms all over the place that can detect this volume. Okay. And so when they detect the volume, these algorithms instantaneously, as fast as light, I kid you not, start scooping up all the shares. And it's not just one institution, it's multitudes of institutions with these algorithms. And then as you are buying this large order of shares or whatever, then what they'll do is they'll sell the shares to you at a higher price and instantly, profit on this instantaneous reward. And so if you were to put in that 10,000 share bulk load, the price would skyrocket, and by the time your order is completely finished, it's up several dollars. Well, here's the problem. Most of your order got filled in far too high for you ever to even think that you would want to buy it, because that's how it works. If the price is already up too high, you're going to wait for the price to come down based on, it's fundamental business. You don't buy high, you buy low. So you wait for the price to come down per the economics. It's economic reasoning. The underlying fundamental principles involved in that company, that industry, the regions, the seasons, right? The trends, the demands justify this price, but now these algorithms have artificially goofed the price up, even though it is still, fair trade, fair market economics. It's just that they're able to work so quickly, right? So these are the quickest phone operators that ever existed, right? They cut out all of the stops. Like, they don't even have to hear, they don't have to speak, they don't have to communicate with anybody. They can just sit there and sense volume data and then instantaneously execute orders on top of that sense. Okay. So in order to compete with that, they made the dark pools. dark pool is where they do this exchange off of the main public exchange. Now, it's not public, it's privately owned. All exchanges are privately owned. But the dark pool is off of that. And so basically it's the same concept as a store where you've got sellers and buyers. It's off of there, and there's actually multitudes of dark pool exchanges. But the thing is, though, is that while it's taking place off of there, off of the main exchanges and out there, you don't see it in the book. That's basically the bottom line. You don't get to see it in the book, the level 2 book. Okay. So it's off of the book, happens, and then all of a sudden it pops up when the order is finally complete. Now, it could take minutes, it could take seconds, it could take days. Okay. But when it's finally complete, it pops up on the book, and then it's done, right? So all of a sudden, you'll see, you can see it in the time and sales, which we can all see. There are, it's not an indicator, but there's a tool on everybody's platform for time and sales, so you can see every order that comes through the exchange. And you can see this enormous order come out for 10,000 shares or 50,000 shares or whatever. It'll make you think, but you don't get to take advantage of it. You don't get to trade around that. You don't get to front run it or anything like that. So a lot of people complain about that because they don't agree that it is fair market economics. But I believe that if there weren't dark pools, the entire economy would collapse, because it would be so risky for institutional traders to do business, or even large private, individuals to do business in the exchanges, and the prices would be so volatile and extreme volatility that it would just, unless you were just a pro volatility trader, which is kind of what I train people to be, you would not have any rhyme or reason for being in the markets, and therefore you would see another Great Depression or semi-Great Depression. Because the confidence in the stability of these markets would just be lost, right? There would be no more, fundamentals wouldn't even matter anymore, right? Fundamentals are how the businesses are doing, how the industries are doing, how the overall economies are doing. And that is why these institutions and these private investors, why they invest, right, in the first place. And the whole point of these markets is to access the public's interest in investing in the public's interests, which are called economic demands. Well, economic demands are just social demands, right? If millions of people want smartphones, okay, rather than take lifetimes to build out the facilities to manufacture and distribute these things in all the stores and so forth, lifetimes to do all this, all the development, all the programming and so forth, well, what we can do is we can use leverage, which is basically borrowing the wealth of the world and applying it to this particular product and its research and development and distribution, and therefore you get Wall Street and anything that looks like Wall Street, right? So it's just public access to leverage. But if you didn't have dark pools, that public domain, well, it's not the government's. A lot of people think that, okay, whatever's a public domain is the government thingy. but it's not the government temple domain. It's private domains, but it is out there. It's public offerings. It's public stocks, publicly owned companies via shares. Okay, and without those dark pools, those things would fail. They would just absolutely be risk haven crock pots full of wackiness, and you're just not going to get serious investors in there, which is the whole point of the thing, to facilitate economic developments, which is social developments. A lot of people think of economics and businesses as these authoritarian temples and orders of cold communist arithmetic and concepts and strict military sincerity. Okay, yeah, it's a little bit sharp and a little bit sheen. Square, yeah, that's arithmetic. Either you're using logic or you'll use foolhardiness and collapse, right? You have to have serious, square thinking, logical thinking when you build buildings and houses and vehicles and planes and trains, and with militarism. Okay, but for the most part, it's just a sociological, sociological system, part of civilization. Okay. The idea, though, of that kind of cold, sharp sheerness, the sheer authoritarian appeal, that concept a lot of times appears bigger than the social aspect of civilization that it is. A lot of people just run from those words. Economics, business, investments and trade. Zoinks! Those are the evil people. Wall Street! Well, yeah, there's evil people everywhere. I mean, there's evil people in San Diego. 100% of San Diegans evil? Evil people in New York. 100% of New Yorkans evil? Washington, D.C. Even the Vatican. Okay? No. So, it's just that wherever you've got a lot of money or power over information and stuff like that, that's highly influential, highly popular, it's extremely strong in the way that civilization carries on over the times. You're going to attract a lot of aggressive people, and in that special attraction, you're going to also attract a lot of evil, immoral evil, and they're impractical. They're just impractical. They don't believe so, but that's how it is. Now, our Wall Street and so forth is heavily influenced by the central temple of doom, right? But you wouldn't call them evil if you were actually inside there. You would just call them well-to-do. I don't even know what they call themselves. Actually, we can't even know who is in any central bank. We can't even go in there. They're actually higher than the government. They're actually higher than all governments. And then, how corporations are, right? They are the stocks of Wall Street. And so central banks funding government corporations funding government, corporation stocks, and currency manipulation around the world, yeah, you're going to get a lot of weird stuff in the Wall Street area. Well, without letting this introduction go on too long, I would just say that if there's conspiracies out there, you need to take care of your money. You've got to take care of yourself. And if these people have got their wallets wide open because they're using your public, your civilization systems. That Wall Street stuff is your civilization systems. Okay, that government is supposed to be yours, right? And laws are supposed to be for you. It's civilization. It's all a social construct. Okay, and they've got their wallets open in your system while they're using it up. So I suggest that you get on board here, learn how it works, get into the conversation, and then, wield some expertise here and establish your own personal wealth so that you're not voiceless, right? And you can represent lots of people. You can also influence a lot of people who can represent your side of civilization so that you're not being conquered by any of this mystery that's going on up there, right? The mysterious nonsense that they're pulling out of the ether at times. Now, is it pulled out of the ether if you trade in the markets? No, you actually have to work. You got to work hard. It's hard to just get into it so that you can make money, and then you've got to stick with it with hard work. So there's no way that this is just freebie stuff. But at the same time, I don't know of any other opportunity to serve your economy and your civilization now and in the future, where you don't need some kind of college degree and many years of apprenticeship or internship, and you can earn this kind of money. Except maybe if you hit it off just right in the computer programming industry. You could be a doctor, you could be a lawyer, those pay pretty well. You could be a high-paid metropolitan architect, right? You could even be a politician. But more than likely, you still won't make as much money as you can make in this, unless you just don't work hard. So basically, as long as you work hard, you can come up from the bottom. I mean, anybody can get the internet, right? So you could either be a computer programmer, or you could be one of these people that trade, that invest, that learn the ins and outs. As long as you can work, right? As long as you can type and read and watch videos, right? Then basically the road is yours. And since when has there ever been anything like that? Ever? I hear a lot of people say, "Oh, well, we should have more free education. You got an internet, shut up." That free education is already out of control, and the school loans and so on and so forth, it's outrageous. So that's a trillion or multi-trillion dollar bubble now that we're going to have to pay for soon. And all they're doing is brainwashing everybody in those universities, right? Yeah, you might find some education, but if you're not equipped to understand the Marxist stuff that they're going to teach you, in between the lines and the narratives and stuff like that, then you're just going to believe that is all the truth that there are. You're going to walk around with a delusion and wind up broke, in debt, and the cause of the end of your own empire, like clockwork. That is by design. So, or you could just work as hard studying, researching, and practicing some skills that you can acquire online. I've learned at least 9 trades online. Right? There's all kinds of communities, right, where experts from various industries, they chat online, asking questions. They've got answers, all kinds of answers, endless answers. There's all kinds of how-to videos, endless information online. It's like the cyber library of everything. There's nothing that compares to the internet, not even the universities. And what do you need a university for if you can just educate yourself online and then get paid from doing that? Anything? Maybe a specialty kind of education, perhaps. Sometimes, yeah. But for the most part, most people are going to universities to make a good living. That's it. They're not interested in any kind of special phenomenon or a passion for scholarly academia, philosophy, sciences, They're just interested in a good paycheck. Which is fine, that's fine, but you can do that online. And here we are. We are training to learn how to facilitate the economy and extract some of that wealth out of those elitists, the number one enemy of the world, out of their wallets, straight out of the wallets. Now, what are they doing in our markets? What are they doing in our economies? What are they doing in our laws, our news, our schools, in our food? Everything. What are they doing there? I don't know, but their wallets are there, okay? And you need to stock up. You need to be ready. The easiest way to capture you and collapse your empire, is to make you broke, make you sick, make you broke, and make you stupid. Especially make you stupid, right? Because if you had to be a general and you had to go fight a country and all of their men were all stupid or sick or broke or all three, could you win? Of course you could win, right? That's the whole point of this. It's called Fabian warfare, right? Which means that you don't directly fight, you stay out of the way of fights all the time. Always be apologetic. It's called PCism, politically correct. Always, come up with some kind of grandiose excuse for anything that you might have got caught doing. But always be working on trying to make everybody dumb, broke, and sick. And then capitalize on it, right? So if I make millions of people sick, then I could probably sell millions of pharmaceutical drugs and treatments, right? And then I can get the taxes off of that. And then those taxes can pay me, who lends your government phony money, right? I mean, how else am I going to launder trillions of dollars every year if your governments don't pay me taxes on things like sicknesses caught from foods and products that copped billions and billions of dollars per region in taxes, as well as the pharmaceuticals and treatments to treat those sicknesses in taxes, and all of the dependency on the government as well. Requires a lot of borrowing. I mean, if you can't work and you're just dumb and you believe things like, I don't know, whatever you believe. If you believe in craziness over pragmatism and practicality, are you going to be able to pay your own way through life? No. Well, then we've got to vote. And we'll vote for more spending. Well, when that happens, then there's going to be your central temple of Doom Bank making magical money appear out of nowhere. And then, Viola, we've got a laundry machine. There it all is. All those taxes come back. Oh, and that's not all. That's not all. And then they're in the stock markets. Then they're in the bond markets. They're in the futures markets, the forex markets. They're in the real estate markets. They're in every market. So basically all they're doing is they're just fabricating the right to control and own anything they want, including what you can know, thus what you can think, how healthy you can be, however you're genetically formed. In fact, they can get into your genes. They can infect your mother before you're born. So when you're dealing with serious stuff like that, it pays to know how to get involved there, and basically start chucking that stuff out the front door on trucks and flatbeds and hauling it back home and investing it into, property, businesses, know-how, time with people where you can influence them and teach them about stuff, about being normal rather than about being crazy, like you get on all of these entertainment and news, broadcasts, the music and stuff like that, the public schools. So that way you're a superior empire, right? You're the resistance, right? You have an immune system as people. There's your honor. That's what your honor is towards, rather than being, made mutants, incompetent mutants, and then completely dependent on everything they say and do. So, so I've often thought of it kind of like an aqueduct. Now, an aqueduct was the old empires, the old republics, means of drawing water from over mountains and such. So you would see these, you actually still see parts of these in Europe. And basically what they are is kind of like piping systems, but they're kind of like bridges at the same time. And so in order to get water from faraway springs to a town, you've got to have the thing built with a slight gradient all the way from the source all the way to the destination. And one of the things that they would do when they would incur a valley of sorts, it would have, basically, once it dipped down into the valley or between mountains and such, where they weren't going to build a bridge, right, because it was just too far, the water would drop from a higher point, and it would drop so fast, and then it would come back up, and it wouldn't have to come back up all the way back up to that height that it started at, and it would effectively just kind of like a roller coaster, and then get back onto the plane that it was on, just a little lower, and continue on its way down the aqueduct. And they would drill through mountains, right? So they would start on one side, and then mathematically they'd figure out where they had to drill from the other side, and then they would meet in the middle. And you would just see these things bridging across Europe. Just these elaborate bridges, which was just piping water. And so, basically that's what these internets are, right? And basically all you're doing is you're piping money out of these exchanges into your accounts, into property deeds, business ownership, your own projects. You could be renting out apartment buildings or trailer houses or whatever you want to do. Just make sure that you're owning things that are substantial. Substantially more valuable than currency. Currency is just the liquid in between ownership of things. Okay? Whereas actually owning things like property, gold, silver, businesses, organizations, societies, patents, so on and so forth, those are real things. So if you get, if you've got economic trouble coming, right, the collapse of the dollar, interest rates spooling out of control, EMP false flags from North Korea, or who actually ever sent it but blamed it on North Korea, or even if you just got like a solar flare, or maybe these Monsanto companies come up with some kind of crazy genetic something, and it just spreads like wildfire over all the places. Okay? Well, if all your stuff's in money, right, or you just don't have very much money, that's a problem. So basically, work on the money, work on your wealth. Your wealth is property, assets, talents, and knowledge. So assets, talent, and knowledge. Now you can hire talent, or you have the time and the money to invest yourself into talent making. But if you don't have enough money, you can't hire it, nor get enough time and access to things that you need to develop talent. Same with knowledge. You can hire knowledge. You need time to learn knowledge. But if you don't have the money, you can't access anything. Same thing with assets, whether it's company equipment or real estate to put companies on and do business, or you name it, any kind of property, any kind of apartment, any kind of anything, right? So if you've got all of that, you've got the exact same thing as any of your enemies, whether they're domestic or they're foreign. And you have a lot of domestic enemies, by the way. And that's how they control things. So it would pay if we had a legion of conservatives that were, able and well-to-do, under the same kind of logic and the same kind of parameters of this landscape of reality, which is this empire, and we wouldn't just die, in an instant, right? It'd be kind of like fountains of wisdom, right? Aptitude, mobility, and able to resist, pockets of resistance. That's what we need. And then from those pockets, in a time of, bad times, then those pockets can bridge together, kind of like the T-3000 on that Terminator movie, when he gets frozen and then he gets smashed into a million bits, and then those bits melt, and then they all find each other again and form the original, the original bot. Just like that. That's how empires are, right? Might be smashed up, but then reform. Now, if you've got nothing to reform with, it's kind of hard, right? Now, you got to imagine that's basically almost everybody's situation, okay? And so there's going to be some competition for who gets resources, who gets jobs, stuff like that. Right? There's a lot of criminals out there too, right? You've got to protect yourself from. You don't want to be put in a position where you got to comply with crazy criminals, right? You want to be in a position where you and a bunch of other people can fend those those worms off. And also create a situation where everybody's not so desperate. They can occupy themselves with improving themselves and contributing to the community in order to survive, right? Regular means of trade rather than regular means of theft and murder and rape and coercion and submission and extortion. And, run-of-the-mill treason. Okay, so back to the 12 tenets here of trading. Here's how my day basically begins and ends every single day as I trade the futures markets, by the way. But this stuff is applicable to other markets as well. Okay. So number one here is look for bounces off of the levels and opening swings high and low. So basically what that means is you've got a market that opens up at said time, such as this. That's the open time. And then you've got the thing breaks out, runs down, okay, runs up, and then starts working around, does whatever. Okay, so basically this is your open swing low, right? This is your open swing high, okay? Every day, within about 45 minutes, sometimes quicker, sometimes it takes about 45 minutes, those markets are going to create an open swing low and an open swing high. And basically what that means is that when the market starts working over the top of that swing high, it means that that's going to be a bullish day, okay? And if it rejects that open swing high, that means something, right? You know how to read a crowd, right? You know how to say, well, the crowd was there were some people interested in the thing, but then basically overall the whole crowd just said forget that, right? So then do you keep on trying to do what the whole crowd rejects, or do you go with what they're interested in, right? And that would be how it works with these open swing highs and open swing lows. So if they reject the open swing high, then probably we're not going to be in a bullish trend. So from there we could be in a range like this, okay? Or we could be heading on down below the open swing low and then start bouncing off of that open swing low, right? Just like a regular, resistance line. Okay, and then basically what you'll start doing is you'll start drawing your resistance and your support line. So this is a low right here, so that's going to be a new level. We'll call that a technical level or a level. So basically technical analysis is the charting where you're figuring out where there's demand, where you're figuring out where there's lack of demand, and basically it's a conversation. Like I was saying, it's a conversation like as if you were in that UN big meeting room. There is such a thing, and you needed a translator to understand it all, so you're understanding the context of what's going on. And that is what these charts are, and that basically that chart is our translator of what's going on. And so via those translations, then we know what to do, what not to do. Okay? And so what I'm trying to teach you is the language that this chart is in, right? So I'm trying to teach you the chart language, and when we draw these lines and indicators and so on and so forth, when we figure out the context of this big meeting, this big committee meeting we call the market, or I call the crowd, okay? It's called technical analysis, which is an economical assessment of potential profits and or potential profitability and potential risks, okay? Which is, your risk is your cost, which is your losses. Okay? Now, on the other side of that, there are fundamental analyses. And when you are fundamentally analyzing any of these industries, these companies, so on and so forth, you're looking at the business from the inside, right? So you're looking at the economics of the industry. You're looking at the economics of the culture. You're looking at how much are they saving, how much are they making. You're looking at job aspects, and you're looking at law, right? Politics. You're looking at the global situation. You're looking at the currencies situation, right? The value of currencies. Okay? On and on and on and on and on. All right. The thing is, though, is when you're doing fundamental analysis, you have to find sources of actual true data, and then you have to realize that there are a lot of investors in these markets that have believed the false data, which comes from governments and propaganda influenced mainstream media. Okay. So you have to look underground on the internet for actual true sources of that information, and then figure out, okay, how long can people go on believing the lies before it falls apart, right? Also, you have to realize that there are hedge funds that are so wealthy, okay? They have so many clients' money in them, invested in them, that they can afford basically their own intel agencies, okay? And then a lot of these, investors, they are buddy-buddy with each other, from hedge fund to hedge fund and so on and so forth. Okay. So basically, by intel agency, I just mean that they have whole research, sectors that constantly research the news. Okay. They've got algorithms that can pump massive liquidity and take it out of markets faster than you can even read the economic data from an earnings report or an economic news report or just basic news about some war or natural catastrophe or political outcome from legislation or any of those kinds of things. The actual statements out of important figures' mouths, as soon as it hits the news tape, these algorithms can read that they actually can decipher statements on video news. They can also decipher anything that comes out on the web, and they're constantly crawling. Right? Have you ever heard of an internet spider that constantly crawls the internet for news sites, all that stuff? That's what they do. But they've also got people that are heavily invested in researching all this stuff. They have to understand everything too. They're also calling all of the companies that they're invested in order to understand what's going on, what's the future like, how have they been doing, that kind of thing. I mean, that's what you do because you're participating in those companies, their processes of business. So, I mean, if you've got any idea about investing your money in somebody else's whatever they're doing, you're going to go there and you're going to get to know them. You're not going to stand way out here and say, oh, I'm okay, you just go mess around with my money. No. You're going to find out exactly what they're doing before you put millions and or billions of dollars, in on some kind of process that they're doing for the, community. It's a social excursion, right? From business to the public, and from hedge fund or private investor to the business. Okay? And not only that, these little, these departments, they actually get a hold of all of the services that service the company that you're investing in. So they talk to all of the distributors. They talk to all of the companies that supply them with materials. They get in every single pipe in and out of that business. Okay? They are like their own intelligence agencies. Right? So they know things that you cannot possibly know. All right? And the thing is, they invest on them, right? Whether they're taking their money out or they're putting their money in. And long before any of this stuff ever makes news, they're already in their places, okay? And then finally one day it comes out on the news and they're there. They're already done, okay? So what do? You have to be able to do technical analysis. Technical analysis is where you're reading the charts with these levels. You're reading the volume, you're reading the indicators, which are algorithms that are taking values in the exchange data and then portraying it in a readable language that you can interpret the committee meeting going on in that exchange among all of the investors. Okay. And so that's what you need to know, and that's what I'll teach you here. Now, what do we have here again? We have the open here. That's this line right here. Okay. The market shoots down. They sell down. They buy it up. Okay. That downward move is the open low, the open swing low. That upward move is the open swing high. It's basically the same. I mean, sometimes it's a little bit hard to interpret, but basically just figure the first 45 minutes and you'll be safe. And in enough time, it'll sink in. If it's not clear right away, eventually it'll be crystal clear. You just have to have enough experience watching these charts. And then from there, you've got that open swing high, right? And so basically it pulls back, it tests the open swing high, and the market said no. So what do you have here? You have a double top. Not only that, sometimes it's going to be a lower high, right? So it pulled back, came back up, didn't even quite make it all the way up to resistance. Okay? And then of course, when that was read by the investors, they said, nope, this market's not going any higher, it's going lower. We don't know how far, but this is a short trade, so everybody's going to make money on the short side. Now, there are investors that see that happening and they're saying, okay, well, when this thing comes on down, I'm going to buy. They always do. They're always going to buy. Okay? They could be wrong. They could be right. They may not have enough money to control the market compared to who's going to control it, otherwise, right? So if the sellers are outnumbering the buyers, then obviously the sellers are going to control the market. And if they take control of the market, then the buyers are just going to go, well, I guess I need to wait because they're going to make my prices cheaper, right? So that's the conversation going on there. It's kind of like chess, right? I mean, you don't make all of the decisions. You wait for the other players' decisions to take, take advantage or take action, and then you make your decisions, right? But you've got options. You're always thinking of your options. You've got many combinations of things that you can do to protect yourself, right, against losses, as well as be in place to take advantage, right, and profit. Okay. So, and these things, those kinds of rules are how it is in any kind of business, whether you're in a pawn shop or you've got a retail store, or you're a contractor for home or business property, building and maintenance, you name it. I mean, even if you're a non-profit organization, it's all the same. Okay. So now, so market sells off and it breaks through here. Now that's a signal. This is a sign that basically signaled to everybody in the market that this could very well be a short day or a bearish day. Market pulls back up to the support line. It deflects off that resistance line, and then it falls on down through this support line. So right, that was the low. That was the new low. So that's your resistance. That's your support line, right? Now that line is resistance and support depending on where the market is in relation to it. If the market is below that line, then it is resistance. If the market is above that line, then it is support. Okay. Now, if the market comes down here and bounces off that, then that's looking like a double bottom, which could be a potential reversal. If the market comes down a little ways and it doesn't even get down there, then it's a really good chance that it's a reversal, right? Because it couldn't even sell all the way down to support. Actually, it turned around before it even got close to support. Now, can something out of the blue happen here? Yes. In fact, this thing could be occurring. This thing could be reversing. It could be breaking through this level of resistance, okay, which would indicate that this is not going to be a bearish day after all. And then somebody walks in the office and says, all right, I got all my homework done. Now let's execute this trade. And it's in a hedge fund, and they've got millions or billions of dollars, and they just hit this program, initiate it. And so as soon as price gets up here, boom, it starts selling off, and then it basically, you get caught in the crossfire here, okay? That can happen. It is a rare occurrence. Now, is that information that you need to know? Yes. In fact, if there's that much of an order coming in that's that serious that it takes control out of context of this big meeting, right? This is traders from around the world right here, all right? And then that jumps in front of everybody. That is a sign, okay? That is a sign. It's a definite sign. And we are going to oblige whatever that is until it is proven that that is not in control. Now, that may take minutes. That may take hours to prove that that is not the controlling narrative in the market. It may take days, okay, before basically that bearish narrative ends, okay? So that's the kind of thing that you're looking for, though, and you're trying to see how long before that out of context, intervention or interception of the daily routine of the market how long before that thing ends and it's canceled out or made null and void by a contradiction in terms where the bulls take control of whatever that is. And so you'll see that bulls will try eventually to take control again, because not everybody's on the same page. And then when they start to take control, you'll see them start to make gains. And if it's heavy enough and sincere enough, that bear, in this case, and only in this case, that bear will take control again and smack the bulls back into their place. And so what you'll see for the duration of that day is you'll see the buyers kind of disappear. So rather than a full extension of the buying that you would normally see in the market, they just won't buy there, and the market will just be kind of weak and feeble. And then basically what that means is that they're not going to give that bear any chances to get higher prices, because that's what the bears want. When they realize that they're not giving that bear higher prices, okay, and this thing is just looking weak, they're just going to go ahead, okay, I got more orders to fill. They're just going to slam the market again, so the market goes another leg lower. But all those bears that normally would have been trading up, they're going, well, I think I will make money to the downside along with, and so they just draw the prices down further and faster. You understand? So we're actually front running whatever that was, that anomaly, until somebody as big as that anomaly steps in and says, no, we've just gone too far, too fast, right? And part of that reversing factor is that us day traders and swing traders, we're going, well, it's about that time of day, and already made a lot of profits here. I think I'm going to do what I do, whatever I do. So that has a lot to do with how markets perform. So it's not just technicals on the charts, it's also the times of day, right? And even the days of the year. So, whether it's around holidays or economic reports or statements or political things, etc., etc. Okay. So you gotta understand a lot about, you gotta understand something about civilization to do this job really well. And then you got to understand the context of this committee meeting, which is your markets, right? And then you got to understand anomalies, which I just described. Okay, so then anyway, on this particular drawing, market breaks through the opening swing low, which indicates pretty bearish. This thing could have ranged in between the swing high and the swing low. That happens sometimes. And basically when it ranges, it just means that there are buyers and sellers basically agreeing that, hey, if you sell up here around this part of the chart, okay, we're gonna buy down here at this part of the chart, okay, and then we're gonna bring the price back up to you, and then you can sell again. Okay, and then you're bringing the price back down to us, and we're going to buy again. And it'll just range like that, up and down in an area, and that's called an area of balance. And that happens quite a bit. Okay, and it doesn't necessarily happen in between the open swing high and the open swing low. It can happen at, anywhere on the chart. Okay, so, but and then you get into your market profiles, which is volume or trading volume on the side of the chart at the price levels. Okay, and so you'll have heavier volume normally around those trading ranges where basically the market just agrees to keep moving the market back to the other side's favor, until finally somebody else steps in and says, nah, I'm not playing that, I'm not doing that, I'm doing my own thing, and then they break it out of the range, right? So, the market's not a unanimous committee meeting, but so anyway, this thing bounces off of resistance here and breaks through support. If it bounced off of this support line and it came back up here, it would indicate a reversal, right? Or if it came down like halfway and then went up, okay, that would be called a cup and handle, where this right here, this area is the cup, and then that halfway down and bounce back up and on through resistance is the handle, like a teacup. Okay, that's very common, and this happens upside down at the highs up here sometimes if it's going to reverse. So look for the upside down cup and handle and the right side up cup and handle. Very common occurrence, very easy trading. Those ones are. Okay. Now, this thing continues to draw down. Well, what happens after the market goes down? People made money, so they start taking profits. When people start to take profits, they do the opposite trade, right? So when they start doing the opposite trade, right, so in this case they're shorting, they've got to buy to cover, which is to take profits. Okay, so when they start doing that, then the market bounces back up. Okay, and when it starts to do that, everybody knows that, okay, well, they're buying to cover now, so this is a short squeeze. And basically what it means is there's not enough offers there on the thing to facilitate all of this instantaneous buying. Offers are going to be up a little bit higher. So it's an easy trade. Once it starts to pull back, good chances are you can catch a little trade here because the short squeeze is going to happen. The bears are going to cover and take profits. Right? Buyers are going to jump on that bandwagon and they're just going to ride that thing up. So for a brief time, the buying's in. Now it gets back up to resistance, and then you'll see all the buyers get the heck out of the way, right? And it'll probably bounce around up here, or it'll just deflect, and then it'll start to fall down again if it's a bearish day, right? Now, here's the thing. This thing may not even get back up to resistance. In fact, it may just bounce up here. Okay. Now, hold on. Now this, that's the new support. Okay. And now, rather than bounce off of resistance up here, because who's scared of buying, right? Bulls are. Okay? So now all of a sudden we get down here, bounces off support. I see this all the time. Bounces up again, but it doesn't even get this high, right? Now this is the new, this is like the new tentative. So this became the new tentative resistance. It's not the main resistance though, and bulls aren't even going to take it all the way up there, right? They're actually just gonna they're just gonna fail right there, and then it'll come back down and it'll break down, right? And so really, what do we have here? We've got a lower high, just like that, right? Basically, that's a trend line, okay? The lower high right there. And you'll see that all the time. You need to draw those things on your chart. You've got to draw all these lines on your chart all the time, because it's got to be in your memory. You can't always remember these things, especially if you're new, okay? And it's got to be there when you look at the thing so that you're able to react to it as fast as possible. It's like a sport almost, right? So if you can't see the foul lines or the hash lines on the field, right, then how are you going to know what to do? I mean, you don't even know where you're at on the field, right? So you've got to constantly draw these lines on the field so that you know where you're at. And the thing is, though, is it's not just you, it's everybody else doing the same thing, and they're going to play by those rules as long as there's enough people in the market. Okay, 90% of the time. Now, 90% of the time, that's making money. And once in a while, somebody breaks the rules, you know, and then you've got to basically watch the action from there and see what's going to happen. But for the most part, everybody wants to make money, and they just want to play by the rules. Okay, as long as you know what the rules are, you can do pretty well. All right, so does that answer one? Look for bounces off of the levels and opening swings high and low. Yes. Okay, so number 2, figure out how the day traders are being treated by the long-term traders. And basically, day traders run the show, and the main time that they're there is early morning at the opens of the markets, okay? And they're there for they could be there for an hour and a half on, say, a Friday or a holiday. They might be there for 2.5 hours or 3 hours. Now, it depends on the action. If the action was really good, right, straight away, and they just made a whole ton of money, they're not going to put the money back in the market. They're going home. They already made what they need. So, but if the action was okay and the market's still doing okay, they may stay for another hour or so, okay? And part of that is actually institutional floors, whether they're prop firm or they're long-term investors, and they have people that have to continuously fill orders and so on and so forth. Now, in the prop firms, okay, they're on their own. They're all individual. They don't have a centralized plan. And they're actually like us. In the long-term investment institutions, on those floors, they take orders from a centralized planner. And so whatever orders they've got to fill, they may be doing it over time. They may have more money on some days that they've got to fill, less money, so on and so forth. So, but the thing is, though, is that us day traders, right, which includes the prop firm traders and the swing traders that are only trading for a few days at a time, up to a few weeks, sometimes a few months, but not usually. Basically, we run the show, right? We're the ones drawing the lines. We're the ones obeying the lines. You know what I mean? And then the long-term investors, they're going along with that for the most part. Unless it's an emergency, unless they just basically, they know what's going on and they've got, this stuff to put in there, they're going to take advantage of us. They're basically going to step out in front of us during the middle of our ball game, right? And they're just going to step out in front of us with total immunity, and they're going to take control of the game, and they're going to grab the ball, okay? And they're going to force it their way, okay? Now, you have to pay attention. They have total immunity. They have total immunity, okay? Why? That's just how it is. Now, we're going to do whatever it is that is going on now, right? So if these ball players came out on your ball field and they've got total immunity, you can't win. You've got to play the game as the game is carrying on, or you can just run away. It doesn't matter, because basically we're going to play the game, all right? And so we're going to play the game according to them. If they want markets to fall down, we're going to run markets down and make a bunch of money. If they want markets to fly high, we're going to run markets higher and make a bunch of money. They know that, okay? They know that. All of these institutions know exactly what's going on. Like I said, it's kind of like one of those UN meetings, all right? We've been here a lot of times. A lot of people have been there for decades and decades, okay? All of their talents are in interpreting these charts. some of these institutions take orders from higher authority in their institutions, right? Which is just, investors, right? Okay. And then they carry out their orders on these charts according to our rules, unless their bosses tell them that their orders are of higher authority and more important than whatever we're doing on the charts. That's when they step in front of the game that's all scratched out and hashed out on the charts, and then they take control. They take full control. But all they gotta do is let us know. They're kind of like people on the elevator. If they want to go down, we'll take the elevator down. If they want to go up, we'll take the elevator up. So here with number 2, you just need to know, how are long-term investors treating us day traders? Are they stepping in front of things? Are they cooperating with things? Well, if they're cooperating with things, you won't know they're there. Okay? But if they're stepping in front of things, okay, now you know they're there. So you need to be able to read what's going on based on that, because that's how we're going to act accordingly. And you can have long-term investors on both sides. You can have bigs on the bullish side and bigs on the bearish side. And if they get into a battle, right, basically you know what to expect. If you got bigs on the bearish side, once we get up so high, they're going to smack the market down because them's higher prices. They're taking advantage and selling. If you've got bigs on the bullish side as well, guess what happens? Once prices get smacked down, they're going to bop that price back up there because them's cheaper prices they're buying. All right, so you basically just read the chart accordingly, and it'll all appear out there. Right? If you know the language, it'll all appear out there very clearly. You'll know when to buy, you'll know when to sell, you know when to get out, So, number 3, are day traders being jumped in front of when trying to get in their VWAP bonus trades? Okay, part of that normal day-to-day trading is that basically a lot of these pro day traders, okay, they're basically just people that can work orders for clients. So, I know a trader in Chicago that has been a broker on the floors in the exchanges, okay? And he would have traders underneath him. And so he said that he used to do trading for the Prince of Saudi Arabia. Okay? I forget what his name was, but I think he's the popular one that everybody knows. And among many other wealthy clients, and then everybody that you don't know. So, and then what he would do is he would take this order and he would break it up into his locals out there, people that are working underneath him. And what their job would be to do is work that order. And what they're supposed to do, if they got to sell all this money, okay, for this client, then what they want to do is they want to sell it in pieces, let the market come back up above the VWAP line. That's an indicator. You'll find it on every platform. When the market gets back above the VWAP line, which is volume weighted average price. So basically it's just an algorithm that averages out all the volume and all the price movements, and then you get that line. It's basically in the middle of the chart all the time. And so once the price gets back above the VWAP, they get a bonus for every one of those contracts or shares or whatever that they can get rid of above that VWAP, and they will do it over and over and over. Now sometimes they aren't so lucky because the market never comes back up above the VWAP line, or it just doesn't come back up enough. Okay, but that's the general idea. Now there are also these traders that are working the other side where they've got to fill orders for these clients. Okay, and it's none of the client's business about what's going on. They're completely detached from what's going on these charts, on these prices, the volume, yada yada yada. They just want the work done at the best prices, and they trust that the broker and his traders are going to do the best job that they can. They wouldn't have the job with the broker if they couldn't. They wouldn't be popular with the clients if they weren't. So let's say there's somebody else with another broker trying to get an order in on the long side. They want to buy. So they come in with, like, I don't know, 500 million or whatever. And so that order gets broken up to people on the floor or on, in the office building, not necessarily the pits or whatever, but you can have a series of people sitting in front of charts on computers doing the exact same thing. Anyway, every time the price gets below VWAP, then they start filling the order. Now, preferably, they would like to fill the entire order below the VWAP as soon as it's below the VWAP right away in the morning. Okay, preferably. So basically, normal etiquette on the charts is that the price goes up above VWAP so that these guys can get their orders filled up there and get their bonus. And then the price goes down below VWAP, and then the other side can get their orders filled in below VWAP and get their bonus, right? And maximize their profits in this business that they're running. Now, that happens. It also is an indication of things that are to come if long-term investors or whoever are jumping in front of that action, okay, and not letting that happen. So if it was the bull's turn, right, and price was supposed to come back up above the VWAP, but then it got bopped down before it could get up there, well, obviously there must be some really aggressive bears in the market. We don't know exactly who. It could be these broker types filling for their clients. It could be just that there's a ton of them. It could be the long-term investors and the hedge funds. We don't know. It can be complicated. But basically, if that's not going to happen, then you know that there's a lot of bears in the market, and vice versa. So if price was coming back down, it couldn't get below the VWAP. Okay, then basically very bullish. It's a very bullish day. Okay, so you have to understand that if these evolutions can't occur on these charts every day, it just means that there's a lot of greed, right? Greed as in hunger, like as in demand. Demand, pounding the tables. I want it all now. Okay, that kind of like aggression. Okay, for these shares or contracts or whatever. Okay, which means that they're either going to have to fill their orders at prices that they don't want to, or they're going to have to wait to the next day. They're probably not going to wait to the next day, which means that they're going to have to be even more aggressive because the controllers of the market are more aggressive. Therefore, you're going to go, okay, well, now they're all in aggressive mode, so I guess this is going to be a very bullish day. So rather than taking short trades, you're gonna go for longer trades and try to make more money on this very bullish day or more money on this very bearish day. And there are indicators where you can see the delta ratio of volume. And one of the things that I've noticed that you can see is basically, for instance, on a bearish day, you'll see the market fall down a leg, and then it'll pull back up, okay, and it'll start to stall out. And everybody goes in their minds, okay, is this the reversal? Is this the reversal? It's like that time of day, could be the reversal, And so I've noticed that I can see on these, they call it a power meter on Jigsaw Trading. And what it is, it's a volume delta ratio of buyers over sellers. Okay? The contracts in the exchange coming through, being executed, being traded. Okay? Buyers over sellers. And I can see that sometimes if the bulls in this case start buying more than the bears are selling, they'll start catching back up, 1-to-1, right? That's caught back up. That's even. The Bears were outnumbering the Bulls. The Bulls will start to catch back up, and then all of a sudden the Bears will start just pounding sell orders out there and dominating that delta ratio. And I've seen it go on and on and on, where they'll have like a 2,000 up to a 5,000. It depends on who it is and what day it is. But basically, anytime the Bulls start to catch back up, they will just put that program back on or whatever they're doing, and they'll maintain that distance in front of the Bulls at, basically a set parameter, 2,000 contracts or 4,000 contracts or whatever. And they'll maintain that all throughout the day. When they allow that ratio to break, finally, whether it's, halfway through the day or all the way through the day, close to the end of the day, okay, when they allow that, that lead over the other side of the market to stop, that's the reversal. That's when they're done. They've given up. The program's over. They may come back the next day or whatever, but for that day, they're done. Okay, and so you'll buy that reversal. Market will be very oversold. You're going to have a lot of bears that have just profited a lot on the short side. They short sold that all the way down. They got to take profits, therefore they got to buy to cover. When they buy to cover, that attracts a lot of buyers that want to buy that short squeeze, so it fuels that reversal even more, and so you get a lot of good buying opportunities right there for a good trade there. It's just something that happens. So number 4 is long-term investing, running the market in continued direction after market should have reversed already. So basically what that means is that normally all the good trading happens in the first hour and a half, 2.5 hours, maybe 3 hours. And then it just kind of fizzles out. So if you've got an oversold market, at about that time it's going to reverse, like always. It's going to come back up until, basically a little ways up, halfway up, quarter of the way up, or whatever. And then it'll just kind of range, kind of like drift in the wind, basically, all the way to the close. Or it's the vice versa, where the market rallied up, it's overbought, okay? It comes around about that time in the day, everybody's profited, they're going home, and then it reverses, then it comes down halfway down or a quarter of the way down or whatever, and then basically it just drifts in the wind and kind of ranges to the close of the day. But if the reversal can't happen, and so let's say it's a bearish day and the thing just keeps on selling lower and lower and lower, or if the reversal can't happen and the bulls keep on buying, keep on trending higher and higher and higher, okay, past that time of day when normally the reversal happens, that is an indication not only for that day that there are long-term investors that have a lot of orders to get filled. It's not only an indication on that day, but it's also an indication of what's to come the next day, the next day, the next day. Okay, basically, whatever they're knowing, okay, you may not know, but you need to have your head up because they control so much of the market that they've got enough money to spend on those, hedge fund, intel agencies, quote unquote, and there's something up. So that's your news right there. So basically, if the trends continue on past that time of day, on any day, keep your ear to the wind because there's something up. Okay, that's basically your alarm system. Number 5, are day traders being trained by long-term investors by crawling under levels they would normally bounce off of or break through at that time of day? So basically, if the market sells off, let's do it like this. If the market sells on off, right, and we expect this thing is going to reverse down here, and the market starts, well, let's say this, right, pulls back up, forms a cup, comes down, starts to form the handle about halfway down to the low, and then it starts to come back up, and it's peeking out over that resistance right there. Starts peeking out over that thing. Well, all of a sudden, as it peeks out, now this is normal. This happens. This should happen. This is a powerful movement. Okay? But as it peeks out, bop, right? The sellers come in there and tackle that thing real hard. Force it on down, straight down through support. Now we're down here. Finally get a pullback. It starts to pull back. Okay. But rather than go up to anything like resistance, okay, what traders are gonna do, bulls specifically, they're just gonna basically, they're gonna hang out down here. Okay. They aren't gonna go all the way up there. They're gonna low crawl. So basically, you'll see them low crawling. So this gap right here between your levels, right? When I say levels, I mean support or resistance. That gap, that low crawling right there, means that these bears are conditioned. Not bears, I mean these bulls are conditioned. Okay, they've been conditioned or trained by these long-term investors now that you don't buy when they're in control. Okay, so basically, one thing the long-term investors can't get the bulls to buy prices back up to resistance, because they just took so much control of this thing so heavily, so heavy-handed, that basically they basically burnt that opportunity up. Normally the bulls would just buy this back up to resistance, okay? But this was so heavy-handed here, okay? It was so serious that they're not going to buy that back up. Okay? So basically, whoever's selling now is going to have to deal with these lower prices, right? If you're selling, you want to sell at as high a price as possible, but they're going to have to deal with these lower prices. So then they take control again, on down. Finally get a pullback. And what's this? That is a resistance line. So that low right there, those lows, okay, that was their support line. Then it becomes resistance once price is down below it. Well, these bulls are scared. They're not going to buy anything. So it low crawls again. Okay? When you see that low crawling, when you see these gaps like this, okay, then basically what that means is that they're trained by the long-term investors that this is going to be, a bearish day. And the same thing can happen on the flip side. So rather than this gap being between resistance, right, it's above support. So it would look something like, let's see. Hold on. Here we go. Now that works. So market opens up, pulls back, runs up. Okay. Now where it was supposed to pull back, the bulls take control of this thing so heavy-handedly that basically they have trained the sellers and the bears that when they're supposed to come back down to support, now this is support right here, support line. They're supposed to come all the way down there and bounce. They won't even get close to it. Nobody's going to sell down there because they're so trained that they're just going to stay up here. And then finally those institutional long-term investors, they start buying it up again because they can see that nobody's going to sell their prices on down here for them. Okay. We're just going to hold. We're not going to sell, first of all. And then the same thing happens over and over. And then what's this? This is the same thing. Okay? They're just not going to sell down to here, and so that long-term investor is going to be forced to just go ahead and start buying again. Right? And that's how it works. All right, number 6. Look for 50s and 70s. That's $50 trades and $70 trades, as in profits, per contract now, rather than 100s and 150s or more on every trade. Now that's per contract. Mostly I'm talking to people that trade minimal number of contracts, like one at a time. Okay. And the reason why is because I've noticed over time that basically if you're looking for too much, you're not getting it. Okay, first of all. And then when you get close to it, you want more of it. And what happens is, you don't get it. And basically the market reverses on you. Well, if you've got something like, 120 per contract, and you're looking for 150, right? But then the market starts pulling back on you because they're taking profits, probably, right? Then all of a sudden you're going, I gotta get out, and so you get out, and then you take much less than what you could have took. Okay? And if you weren't looking for 50 or 70 and you were looking for 100 or 150 instead, then what happens is the price pulls back on you, and then you're going, I should have taken it. So you take 10 or 20 rather than 50 or 70. Or, even worse, it pulls back and then it starts losing on you. Start losing on it. Okay? Now you get out, and then what happens? It goes back the other way again, right? So, just get out of all of that confusion and just stay consistent. Okay? Ordinarily, if the thing gives you 50 or 70 pretty fast, that's a good trade. Okay, just take that. That's normal. That's what everybody else is doing. Per contract now, that's per contract. Now, if you're doing more than one contract, then get a calculator and figure out what is, however many contracts that you normally trade times this many. Okay? And then go with that. You're also going to have to consider slippage. Right? Consider slippage, which means that, if you start exiting that trade, exiting that position, you got to have enough traders on the other side of the market there to facilitate your trade. So you might not get the price that you're looking for. You might get a lower price, right? And so you're going to consider some losses there. That's going to cost you a little bit. But basically, if you're trading one contract, you're basically going to get your price every time. Now, but this is consistent. So rather than trying for this all the time and then losing it all the time, right? or having this much, which most often is the case, 50s and 70s, and then losing it, and then losing more. Just take these 50s and 70s. Now, if the market moves so fast, which it does sometimes, and now all of a sudden you got 100, 120, 150 or whatever, okay, or maybe a couple hundred, okay, per contract, then hit the bleep and close button and get out of that thing, because it's not so often that you get that opportunity. Just take it and run. Forget about everything else. Look for another trade. Look for it to set up again on that chart. It probably will. And or be looking at the other markets for another trade. But that trade is done. Okay? You're not a big institution. You're not a big wealthy private investor. Probably not. So it's pointless for you to go, well, I can keep on trying for more because I've already got this much. I don't know when it's going to turn around. That's right. You don't know when it's going to turn around. Take that and go. Because that's more than you were looking for. Okay? Go pay your house bill with it. Whatever you got to do, put it away. Right? Use it to pay down the cost of another trade that goes wrong or whatever. Or a real big one that you needed some really big drawdown, to actually get and make a bunch on or whatever. Okay, but just grab it and go. Don't wait around and lose it, because I'll tell you what, I'll just promise you, if you're going to go ahead and try and do that, okay, and not do what I'm saying, basically what you're going to learn is that most trades are this, 50s and 70s. Some trades are hundreds and 50s. Okay, now that's bouncing off of those support lines and resistance lines, right? The breakouts, the reversals, that kind of thing. Okay, most trades are 50s and 70s. Some trades are hundreds and 150s, and very once in a while, multiple hundreds. Okay, and what you're going to find is that if you're not just sticking with the 50s and 70s, like you know are the most common, then what you're going to wind up doing is losing more, looking for more, than you will just taking what you got and rolling. Just roll with the punches. Take what you got and roll with the punches. Just take these 50s and 70s. It's going to add up to a lot more than waiting for hundreds and 150s all the time. Right? Now, if the market just punches it to you, there's nothing you can do. Just close the thing and that trade is done, right? Sometimes that happens. But don't be waiting around for it all the time, because it can take too long. If it takes too long, you're going to wind up losing your profits all the time. I promise you. Let's just say it like this. 90% of your trades is 50s and 70s per trade. And they at least half of those reverse. Okay? And then like 9% of the trades are hundreds and 50s. Okay? And then more than half of those reverse. Okay? And then what do they reverse to? Either it's 50s or 70s, or back to zero or less. Right? And then like 1%, probably less than 1% trades. Yeah, less than 1%. Of trades actually punch it over a couple $100 per contract. Okay, so if it punches it into your account, take it. But otherwise, just grab these and go, and be looking for other trades. And you can make a dozen of these things a day, at least, in 5 different markets. Your 5 main markets: the euro, the gold, the oil, the NASDAQ, and the S&P 500. And the same thing can be true on the stocks too. And if you trade Forex, you can include that in the mix. Have a bunch of monitors going on, just keep on marking the charts. But anyway, practice number 7. Practice the bounce trades in one down, opposite of the focus trade in another down, with the focus trade constantly on. So basically what I'm saying by practice is, just do it. And have 2 domes, right? Depth of market ladders, okay? I don't have a picture, but just Google it if you don't know what that is, or YouTube it, search it on YouTube. They'll explain it. So have 2 going on, and have it so that when you trade long on one in the same market on the other one, you can trade short, and they don't control each other, right? They got to be completely separate, but in the same market, and you can trade opposite trades. Okay? And your focus trade is like, okay, let's say you're basically seeing a bullish market, so you're long. But what does the market do all the time? It goes up, and then it comes back some, and then it goes up, and it comes back some, and then it goes up, and then it comes back some, and then it goes up, and then finally it breaks out and goes higher. And then once it goes higher, then it comes back some, and then it goes back up some, and then it comes back down some, and then it comes back up some, and then it breaks out higher and does the same thing over and over. Well, you've got one trade that's in there for the long haul, right? Because the market's trending higher and higher, so that's your focus trade. And then on the other dome, you're actually shorting on those little reversals. So where it pulls back, you're shorting, and you're taking like 4 ticks or whatever. Probably about 4 ticks, maybe 6, maybe just 3. Depends on what's going on. Okay, but you shouldn't be losing on those little reversers. Okay, those are basically there to fund any kind of cost loss, any kind of cost loss that you have on your focus trade or any future trades, and then have some to spare extra as well. So basically, while you're waiting on that focus trade to work out and return the money and with a profit, okay, the side trade is also making you money too. So it's kind of like having a main job and a part-time job at the same time. Okay. And practice that. I'm saying practice that. And by bounce trades, I mean when the price is bouncing off these resistance and support levels, okay, you could be taking advantage of those bounces. Okay? And I don't recommend doubling up. I don't recommend doubling up unless you have a very tight stop order just behind it. And normally if I double up, I only do it right at about the support or resistance before it's going to break out. Because if it's not going to break out and it's just going to bounce, then I'm in at a good position. And as soon as it gets halfway back up to where my first contract was entered, okay, then I just get out of the first contract and I just hold that second contract that I was doubled up on, because I don't want to have double the risk. Double the risk is like trying to drive a truck through a tunnel double high, right? So what's going to happen to the top? It's going to get whacked off at the tunnel entrance. Right? So get that thing off there as fast as possible, wherever you break even in the middle of the 2 entries, the entry up high, the entry up low. In the middle, you'll break even. Right? So get that first contract off of there, out of your position, so you're down to 1 contract or just that one piece. You don't want to be doubled up. You don't want to be doubled up and this thing reverse on you, because if it reverses on you, right, you can only take a few ticks loss. So that's why when you double up, you only do it down there at where it could reverse and break through the floor. Okay, and so you got your stop just on the other side. Right? If it's going to reverse, then you're not going to lose much. Right? But don't ever triple up. Right? Unless you're extremely pro. Now pros can do it. Okay, and if you don't know what pro is, then you should never triple up, which is like, triple up, I mean like you break up your account into 3 parts and then you're tripled up, so you've got your full account in one position. That's breaking every rule in the book. That's driving 100 miles an hour head on into Autobahn traffic. Okay, that's insane. the first thing that you should do when you've got extra size in your position is be looking for any chance to break even and get that extra size off your position. Okay? Because if the trade goes bad, it's going to cost a lot, right? And you don't want to pay for these trades, right? You want to make profits on these trades. I mean, if you've got to pay for a trade, then you want to make sure that it's easy to cover the cost on that loss. Right? So keep those losses small. Now that's the name of the game in every business, even just budgeting your house, right? Or even playing sports. Don't get completely demolished so you can't play again, right? Try to buffer down the injuries and the damages so that you can heal fast, you can recover quickly, and you can get back in the game, right? Same kind of sense. To continue with number 7, through this practice, your intuitive vision of the ability to scratch any trade which recedes past its technical levels established on the chart. I did not completely write this out. Through this practice, your intuitive vision of the ability to scratch any trade which recedes past its technical levels established on the chart should be developed. So, how do you understand the language that you're speaking? How do you understand it? Through practice, eventually you had a vision for the language that you're speaking. How do you know the rules to a sport as you're watching it on TV if you watch sports? Well, through practice, routine, basically, eventually it became part of your vision. How do you know how to drive? The same thing. Okay, so in order to develop really going on long here. In order to develop that intuitive vision to be able to scratch any trade, not sit there like a deer in the headlight, okay, you need to practice this opposite trade, like I said in the first line of number 7, which is just the short trade opposite way, bouncing off of that resistance, bouncing off of that support line, depending on which way your focus trade's going, right? So if you're bullish, then you short the bounce off of the resistance line, okay? If you're bearish, then you buy the bounce off of the support line, okay? And then you get ready to scratch that trade. If that trade goes bad, it starts going bad, you got to scratch it real quick, okay? And then you just look for another trade and you take that loss. That was the cost of that trade. It was going to be good, but it turned out it wasn't. Now, if you can scratch fast, right? If you see it going raw and you scratch fast, then you know that basically you're always going to take small losses, and overall in this business practice, your winning trades are always going to pay for those scratches and then some. Okay. So, opposite trading, oppo trading, right, off the bounces, opposite of your focus trade, practicing scratching these trades when they go bad. Practice scratching. Just get used to just killing that trade if it's going bad. Don't be sticking with a loser. Okay. Then you're going to get this vision that you need. Okay. And basically you're always going to keep your losses small so that they don't overpower all of your winners. You're going to have winners, but they should be making up for your losses and then some. And the thing is that if you're practicing actively, interacting with this thing according to these rules, okay, all these technical levels that I'm giving you, all the communication coming through those charts with the big market, then basically, eventually, you're not going to scratch so much because you're just not going to make those kinds of trades, right? So you need to be interactive. You need to play by the rules, practice the rules, okay, on sim, okay? And eventually the vision's going to come in. You're just going to speak this kind of thing. You're just not going to get into bad trades. You're going to just get into good trades. So therefore, the cost of trading goes down and down and down. The last part of number 7 is it also establishes the productive and intuitive vision from the continuous and routine practice scalping, practice of scalping the small bounces in between those technical levels established. So, I mean, if you're always practicing that scalping in between there, and maybe even keeping a long-term, not a long-term, but, a longer trade all the way up the trends or all the way down the trends at the same time, right? Then eventually, basically, your vision is going to come in. You're going to be very productive, right? To think otherwise is really counterintuitive. You're just going to be more productive, which means you're profitable. Not only profitable, but you're reducing your risks, because you're seeing the risks. You've got to be able to see the risks before you can reduce the risks. And if you're seeing the risks, because you're constantly practicing reducing the risks, your mind's naturally going to see the language and say, in trading language, how to mitigate those risks. Not only that, not just mitigate them, but take advantage of them and profit off of them, right? Which may seem counterintuitive to you right now, but if you're just practicing what I'm telling you, eventually you're going to start to see that wherever those risks are, you could be profiting as well. Thus, you increase your productivity, right? And the piece of the pie gets bigger and bigger. Remember that as your account gets bigger, then your trades can get bigger. As your trades get bigger, then your profit gets bigger, and then your account gets bigger. So it's an exponential process. It's kind of like a piece of the pie, like a pie diagram, right? So you start out small in the center, and then it just gets wider and wider and wider all the way out to the edge of the pie, which is like basically when you stop trading in your life. So I don't know when that's going to be, but you want that slice of pie to be as wide as possible. What's the other slice? The other slice is all of your losses. Now, keep this in mind. A loss is the cost of trading. Now, the cost is permanently lost. Technically, it's permanently lost. Okay? And the profit that you could have gained, could have, would have, should have, increases exponentially over time. Okay? Now, in 50 years, let's say, okay, the profit from that one loss would be exponentially greater if you hadn't have lost it. Okay? So basically, you want to keep those losses as mitigated as possible so that at the end of the duration of your life, when you stop trading, that the loss slice, okay, that empty loss slice, is as narrow as possible at the edge of that pie diagram. And your profit slice is as broad as possible. It's an exponential evolution. Whatever you lose exponentially increases, theoretically, okay, unto the last days of your trading days. Same thing with your profits. Okay, everything that you gain should exponentially increase as well. Okay, now, if you come into this business and you only see profits as the job, like I'm just here to get profits, no, that's not the job. Like a duck with one foot, okay? You're just going to spin around in circles. And with one wing, you're just going to fall on the ground, right? I mean, you got to have both sides of this. yeah, you're going to take some profits, but you've also got to work and be productive at reducing your costs, paying for the costs of those losses. You got to find something to do to pay for those. And so if you're practicing these levels, perhaps trading both ways, then you're paying for those costs. Okay? You're learning the language more interactively, and therefore you're developing kind of a defensive duck foot and a duck wing. And so you're not falling over, you're going places, right? You're skating along. One of the things I should remind you, so let's hear this, okay, is that if you're counter trading, so you've got a long focus trade, and then let's say that's a long trade, and then you counter trade when it bounces off resistance, and you short that, okay? So you short it for like 4 ticks, and you just keep on doing it in that range until it stops working. Okay, then your focus trade just makes more money as the market trends higher. Okay. Well, here's the thing. You got a long position, you've got a short position. They're equal in size. What does that mean? You're effectively flat. So if one of these trades goes bad, what can go wrong? Nothing. Nothing can go wrong. Because when one loses, the other one profits exactly the same amount. Okay? So the reason why you don't just close one and open the other one is because the market moves so fast that it's actually more profitable to open both up at the same time. And if it moves too fast out of your control, then you don't lose or gain anything at worst, which is actually a lot better than losing anything. And that should be your first priority in investing anyway, which is just breaking even. At least that's the number one goal, just break even. You can accidentally profit, trust me, but you can't accidentally break even. That actually is work. You can also accidentally lose money. That is actually just not doing your job. Right? That's the one-legged duck, the one-legged, one-winged duck. And so basically what I'm saying is, while you've got that counter trade going on, you're neutral, okay? And that's safe. And it's also more time savvy than actually closing one side and opening the other side. Because what will happen is the market will move out of your control. You won't be able to get the other side open on time, and then you're losing on that one. And so it's just a bigger mess. So that's what I've learned as far as what I know. Number 8. The practice of many scalp trades with and opposite of the focus trade should be rudimentary and robotic to your trading nature, not one of much judgment at all. So when you are watching your favorite show, okay, if it's your favorite show, you probably don't have to sit there and think much about what they mean when they're talking, because it's your favorite show. Okay, so that is where you need to be when you're doing these focus trades and these backwards mini scalp trades. Okay? It should be robotic and rudimentary. It should be immediately intuitive, just like when you're listening to your favorite shows. Now, when you're listening to these educational videos about things that you don't understand very much of, at first, you've got to actually kind of think hard about what the person is saying. And still, you may not understand everything. But what you'll find is that after studying these videos and actually through practice, okay, eventually, everything these people are saying becomes very intuitive, immediately intuitive. So you can keep up right along with them, okay, and the conversation that they're in, and then apply it to the charts immediately without missing a beat. And that's where you need to be. Okay, and the way that you get there is just practicing this focus trade and mini scalp trade off of these lines, these technical lines, technical levels, the support line and the resistance line. Okay, just keep on practicing on sim over and over and over, like batting practice or golf practice at the driving ranges, at the hitting ranges. You just got to keep on going in there and keep on practicing, right? And eventually, it's going to be in your second nature. It's going to be in your, basically you can speak the club, right? You can speak the bat. You don't just hit with those things. You're actually speaking with them with dexterity and finesse. Responsive immediateness, right? And that's how it's going to be for you on these charts with this trading stuff. To continue with number 8, just analyze levels and trade those levels in the proper times and markets where the crowd's participation, thus the liquidity, is higher. So analyze the levels. That means hash out your resistance, your support, your open swing high, your open swing low. Get your 34 EMA, that's exponential moving average, on there. Get your VWAP on there. Keep an eye on those. Okay? Trade when the market's the most liquid, which is the first hour after the opening. Okay? Sometimes they're kind of liquid before the open, but the thing is it's not as liquid, so it's a little bit, it's kind of riskier. It's more volatile. In other words, it's more unpredictable. Well, in investing, you're going to learn that the more predictable your investments are, the more profitable you're going to be. So if you need to make money, you need as many participants as possible to control the market. Kind of think of it like you're going to take a marker and you're going to draw a line. Hold a marker in your hand firmly with a fist, and you're going to draw down on that sheet of paper on a table. But then there's some people around you, and they got big hands and big arms. They're bigger than you, and they're just going to knock that market off. Right? So, well, in terms of trading, you just lost. Okay? So, but if you've got 100 people all holding on to your arm and your hand, and they're just going to hold that hand steady, and somebody comes in there and tries to knock your hand off, guess what? They can't move it, because it's going to actually take a ton of counter trading to do that. And if everybody knows that in the market, then what are they going to do? Are they going to go opposite of you? No. They're going to join in with you. It becomes a team effort, okay? Because there's an incentive. That can't go against it. Might as well join them. And that's what you want. You want that liquidity time, the most abundant participants in the market, which is at those opens for the first couple hours. Now, after a couple hours, profits have been made. Keep an eye. You can tell how much they made already. If they made a lot already, then they may be leaving quicker. Right? They may be leaving quicker. Okay? This ain't the most interesting job. I mean, if you go to any workplace and you start talking about, let's leave. Well, at the beginning of the workday, they're going to think you're crazy because they want to make money. But once it becomes close to the end of the workday, they've already made the money that they want. You sound pretty smart. Okay. And so you got to watch that. All right. Have they already made their money? Is leaving the market sounding smart? Is it sounding smart or not? I mean, if you've got common sense, you know exactly what I mean. Economics and business and stuff is a practice in the sociological evolution of civilization. Okay. So, I mean, if you have utopian understandings of civilization, it's not to say that everybody's a bad person, but I mean, if it's a boring old job, there's probably not going to be a lot of interested people interested in staying all day, right? I mean, that's just common sense. Let's just say that there's not a lot of demand for a bunch of people to sit around and stare at the same thing all day when they've already made hundreds of thousands of dollars in one day, in one scoop. Okay. I mean, that's just ridiculous. And nobody needs all the money in the world, right? I mean, what are you going to do? Work all the time and never spend anything? Well, perhaps some people will. Okay. But that's not the majority of people that I know. This is the real world. They're gone. They're going to the golf course. They're going to the bar. They're going out to eat. They're going on dates. They're flying around. Anything. Now they can afford it, right? To continue with number 8. While this is when and where the established technical levels are obeyed by the crowd, and disobedience to the established technicals instantly implies a universal understanding to the crowd, thus their universal reaction in accord with that abrupt trading pattern out of context to what the majority of the market participants practice per the established technical levels, some trades will be bad. So basically what it means is that you've got times of high liquidity, which is consistent. You've got traders that are controlling market together per the technical levels. Okay? Pretty consistent stuff, routine stuff. But there are the abrupt incidences where, I don't know, just these immune hedge investors, they come out on the field, they grab the ball and they run the market their way, and it's not working the way that you assumed that it would go. Okay? That happens once in a while, and that's going to cost you. Okay? At first. Once you know what's going on, though, you'll be glad you know. Now you can, pay for that cost and then some. Okay? So, it's not a big deal. But those are your bad trades. Basically, those are your only bad trades. Okay? Bad trades are to be expected. They are called cost of your product, which you've invested in. And you should fully understand your cost before practicing business or any other budgeting exercise in your home, as well as any risk in any given situation in your life. Pretty self-explanatory. So your product, like if you were selling candies in a candy store, your product is the candies that you buy from the different companies. Right? In this case, you're buying shares and futures and currencies and so forth, right, to fundamentally keep the entire civilization sociological system afloat. Right? Now, can you imagine if you weren't doing this job? What would happen? The Great Depression. Remember that? Well, what was the world for 25,000 years before this stuff even started happening here in America? It was like the permanent Great Depression, right? So you got to do the job. It sounds like quantum physics or crazy stuff to everybody else out there, right? Okay. In the ordinary Main Street workplace, okay? And that's kind of how it works. On the Wall Street quantum physics level, it's kind of funny. Like, you're buying products and selling products? Huh? Yeah, that's what I'm doing. And I'm gonna do it. What if I buy posters and sell posters? Does it matter what it is? Okay. Well, in this case, It's actually going to help more people. How about that? And that's going to help me more because I do my job the right way. How about that? Look, we put this institution up so that us people could put our money into the economy and help it out. How about that stuff? That's pretty good, right? So we're not in the Great Depression. There you go. That's the beans on that. That's all you got to know. That's all you got to say. Okay? So, but the thing is, though, is it's a product. And you're a business person, and you're investing in a product. Now, what happens when you go into business and you invest in products, and then you don't make a profit on it? You go out of business. It's the same in this kind of business as well. Even down here on the quantum physics Wall Street level. Okay. Even down here in weirdo economic world, you can still go out of business. And I'll tell you what, I've been to business classes. I didn't major in business, but I've been to business classes. And basically, the statistics are that all small businesses, 90% of them, all go out of business within 2 or 3 years. Then, of the people that come back, it's like, it's a small percentage. I forget how many. But on their second attempt, much more than 10% succeed. It's like 50% succeed or something, right? Because now they kind of know what they're doing, right? They're investing, they're managing, they got to cut costs, they got to pay for costs somehow, so they got to keep on having income coming in somehow, some way. They got to keep on saving, cutting costs, not wasting, making sure things last, making sure that people are trained, okay? And then they got it. Now, there's still about 50% of them that fail again, right? Maybe this time they realize that they're in the wrong business, they're in the wrong market or industry or whatever. And then of the people that come back for the third time, like 90% of them succeed, right? Because now they know what they're doing. Right? It's the same in here. There are tons and tons of stories of traders that invest, $75,000, $150,000, $1 million, and they blow up their first account. They blow up their second account. And they either get it on that third account or they blow up the third account, then they got it, right? Now, that's actually the old days. Nowadays, you can just do a simulation trading thing, right? I mean, you just pay a little bit of money, get the exchange data, do simulation trading, practice, get the skill, and then you don't have to blow all these accounts, right? You can just start making money. Once you start making simulation money consistently for, like 6 months or so, then you go to the real stuff. Okay, so to continue with number 8, the intuitive vision that comes with this kind of cost analysis, cost limitation, and counter trading through small opposite trades to ensure the focus trades are all risk adverse, and a lifestyle choice is a lifestyle choice which is not immediately intuitive in life. Basically, cost analysis is loss analysis. Where are the potential losses? Can you see them fast enough? Right? The best always see the risks instantaneously. Cost limitation. How do you prevent losing everything? Like, for instance, if you buy a car, get insurance, because that car could actually cause you to lose all of your money if an accident happens, right? If you buy a house, make sure you've got some kind of insurance contract so that if you blow the whole house, right, burns down or whatever, then somebody's on the hook to cover all that cost, right? Because you've been paying them, right? That's your limiter. That's how you limit the loss or limit the cost. Therefore, you're not starting over again, right? So you don't miss a beat. Yeah, it takes a little time to get everything back going again, but you don't miss a beat. It's not like you got to earn it all over again, okay? So cost limitation is basically hedging. Now, if you don't know the word hedging, Google that or look it up on YouTube. But basically, it's like an insurance policy. But in these terms, in trading and investing, basically it's financial engineering. So you're setting yourself up, your portfolio or your trades or whatever, with multiple trades and stop orders and where you take profits at without being, like waiting for hundreds and hundreds of dollars. Just take some and look for the next trade, and all of these cost limitation things, preventing your losses. Right? This is what hedging is about. Okay, and then the counter trading through small opposite trades. Right? So basically, if you've got a focus trade, you're bullish, and you're doing some counter opposite trading, the scalp, off of that resistance line. So that way you're actually covering the cost of any losses that might be incurred on your bullish focus trade. But then also, if your bullish focus trade is a winner, then those profits from that counter scalping trade bouncing off of resistance, the profits from that get added to your focus trade. Now, whenever you have a loss in the future, right, now you're covered. So you're paying for all of those losses. Think like that. You've always got to think like that. Right? So instead of just waiting on a focus trade to follow all the way through, you can be working on another trade at the same time. And therefore, it's like a part-time job on the side or something. And these things are basically lifestyle choices. It's basically lifestyle choices. You're your own boss, right? You're going to choose to live this way, okay? It's your lifestyle, right? And I think that once you lose enough for a long enough time, these kinds of things that I'm teaching you are going to inspire you, right? If they don't inspire you now, right, but that income is what's keeping you doing this, eventually you're going to lose enough that this kind of wisdom is going to inspire you. And what you're going to learn eventually as a self-employed entrepreneur is that basically you only do what inspires you when it inspires you, and you just avoid anything that doesn't inspire you. As long as you're covering ground on the terrains that are in the basic direction of where you need to go, right? So, this might seem like a lot of work or confusing at first, but eventually you're going to be inspired because you're going to start losing. You won't be able to make anything, and then you're going to start, looking for ways to pay for these costs and stay in the thing. Then you're going to cover some real terrain, right? Some wise choices. And then, that's just how living is. I mean, basic household keeping, anything you do when you're driving, you got to assess risks. You got to limit the risks, limit the losses. Everything you do, basically. So, yeah, it is all around. It's a lesson learned for life. Anyway, to continue with number 8, a duck with 1 foot and 1 wing may swim in circles and fall over on the ground. So will you if you don't include risk adversity practices with as much devotion to gaining, making, earning, and experiencing, whether in your business practices or in any other part of your life. I think we explained that. So basically, don't just look at all of the profits that you could possibly get. Try to figure out what your other foot is, which is mitigating your risks by being able to see your risks, doing things, practicing things, getting involved in things that are going to get that other foot active and moving so that it's controlled, and it's just part of your language and the way you walk and the way you talk. Okay? It's just a part of your lifestyle. Okay? And so figure out how to get that thing moving so it sees. It's very sensitive to any kind of risks. And then as soon as you sense any kind of risk of loss or costs, then you've got intuition that says, okay, so I can do this and this and this, and that's going to cut down the costs so that if it goes bad, then it's only a small cost. Right? Or I won't lose anything because it's such a good hedge against losses that I'm going to profit. That I'm going to profit anyway. I'm going to profit so much trying to limit my costs that even if I lose anything, I'm still profiting. But if the thing goes right in the first place, then I profit on that and I profit on this. It'll come to you after a while. It's called financial engineering. Hedges make money. Just remember that. Hedging makes money. It's another job. It's insuring your main investments. Yeah, so you don't have to start over, so you don't blow your account. Or all the money you've ever made in your life, but it's also profitable. So it too is an investment. Risk assessment perception is fundamentally key before the ability to solve for the problem of risk. Right? So you have to be able to assess something before you can solve something, right? If the sink works is broken, you've got to get down there underneath the sink and inspect everything to be able to assess the problem before you can fix the problem, right? So same thing with risk. You have to be able to see where's the leaks, okay, before you can actually fix those leaks. In the capital business, risk is cost, and it is cost that is lost forever, exponentially, as the capital does not return with a profit to be reinvested and repeated increasingly exponentially over the duration of this practice. Instead, that cost is lost, and the amount of loss increases exponentially over time, like an empty slice of pie chart that broadens from the beginnings to the center, beginnings in the center towards the full extent at the edges of the pie diagram, in order to mitigate its hold over the entire pie, which you earn in your entire lifetime. You learn to pay for costs while you are waiting on your focus investments to return with profits. In this way, you have a second job or business which not only funds the costs involved in your primary focus investment, but you also are profiting there too, as this practice more than covers any risks of losses in the focus investment. As a result, the exponential gains in overall said pie of profits in your lifetime exponentially increases in value as the cost of losses exponentially increases, but even more potent, this is not increases. It's decreases. So, overall, as a result, the exponential gains in overall said pie of profits in your lifetime exponentially increases in value as the cost of losses exponentially decreases. But even more potent is the exponentiality when all of your focus trades are fortified with this pure paradigmatic vision of cost assessment and resolution. This phenomenon is at the core of meaningful life, the core of wealth creation, and the core of all military planning, training, and further planning with training. In other words, it's an intrinsic detail to the full exploration of life, to each person's full potential. When in doubt, search out the great reversal. Now this is number 9. And cash out for the day. Okay, so now this basically just takes a complete spin here. So number 9, when in doubt, search out the great reversal and cash out for the day. So I mean, if you're going haywire and you got, like, I don't know, there's things going on, and so you're just not in the zone, or you're in a hurry and you don't have much time to mess around, and then just kind of eye the charts and be looking for those great reversals, the cup and handles, the double tops, if you know what they look like, they're very routine. They happen every single day, okay, at least on one of the markets, okay, and then just trade that one, and there you go, you got it. Or trade the 2 or 3 and so forth, and that will be just fine.
Mattress Firm announces our coolest sleep sale ever. Get Hampton & Roads Pillow Top Queen.
I've said it many times. You can actually make pretty good money just trading those reversals, the great reversals. Every time. They're always big, they're always good, they're always guaranteed. Once in a while, the big institutions step right in front of them and they'll catch you off guard. But for the most part, always profitable. And if you just limit your risk, then shouldn't be a big deal. Number 10, look for the day traders to make the cup and handle when they are trying to weasel out of the great reversal of the day, and after being right for the first part of the day up to the pivot, the size trap is going to be there. Okay, so what that means is that there's a size trap that goes on at those reversals just means that there's a lot of traders caught on the wrong side, and that's something that you can look for, and look for them weaseling out, and then trade accordingly to your advantage. So let's say the market's been running down, right? And then it finally bottoms out and it pulls up. Okay? Well, once it pulls up, this market has been running down for a while, all right? So there's a lot of bears in here, and they've all been short and so forth, right? And so they want the profits of this whole move. And so what normally takes place here is they're trying to get out of positions. They've got a lot in their positions, and what they have to deal with is slippage. Okay, and so normally the routine is that basically market pulls back at about that time, and we can tell by the bars down here. So you got a long quick tail, a lot of volume there. The price didn't really move very much. You got a lot of volume there though. That's a hot bar. That indicates that there was a big fight. So this is the reversal, and you can go over that kind of thing in a lot of my other videos. But basically the price comes on down, reverses, and then it comes back halfway, about halfway. Now, could it be less than halfway? Yeah. It could be more than halfway. Yeah. Sometimes it makes a double bottom. It depends on the situation, but that's kind of rare. And basically what's happening here is that you got a lot of shorts that want these profits right here. Okay. And what happens is they get back up to here, and then they just add more positions. They probably bought to cover down here or whatever, but they can't get out. They can't get out without causing this market to just continue flying higher. So they'll get up here and they'll sell again, and then they'll dump everything about halfway out where they're breaking even. Like halfway is always break even. And so basically they don't get the profit all the way down here, but they, maybe here theoretically. Okay? But it's not like they're actually giving all of these profits back. Slippage is hard to deal with, and if you don't understand slippage all the way, then go on Google, go on YouTube, and look that up. But basically, it's kind of like trying to drive a big semi truck around corners in the city. Okay, you've got to overcompensate because you've got so much load on the back. You know what I mean? You're taking up a lot of room. And when you've got a big position on the market, basically it means you've got to have a lot of the other side of the market to be able to trade with you in order to get out at the price that you want to get out. But if they're not there, right? Like, what's the hardest thing to do when the market's turning around from bearish to bullish? It's finding people that are going to sell to you, right? Why wouldn't anybody sell to you if the market's reversing? Because the market's reversing, right? It's kind of counterintuitive. So let's just go extreme here and say I've got 100,000 contracts and I've just shorted all the way down here. Well, now I got to find a whole bunch of people that are going to, basically, I'm buying to cover now. So they got to sell me 100,000 contracts, but we're turning around here. So nobody's going to sell me 100,000 contracts just like that. Okay. And so what happens is I'll start to liquidate here, okay, with the measly offers that there are to sell me, because I got to buy to cover, right, to get out of my short position. Not only that, there's other people that are buying long, right, because they know that I'm buying to cover, like everybody else that just drove this whole thing down. Okay, so therefore price is going to get out of control, and I'm not going to be able to get out of my position until price is way up here somewhere. So normally what happens is basically it's just routine. These institutions just basically just have it in, it's just kind of a cordial relationship, cordial etiquette. It's just a cordial mannerism that basically will reverse, and then they'll just sell the thing back down. And then about halfway, that's where they'll dump the rest of their position, okay? And then the thing will fly off. Okay? And then basically, they don't get out of all those positions quite all the time. Right? It's kind of difficult. And so that's to your advantage, in fact. But not only that, there's a lot of trailing stops and that kind of thing. There's algorithms and whatever, and they've got their stop orders right here, right? Their stop loss orders right above this line. And so when we make this handle, what we're going to do is we're actually going to blow right through them. Okay, so all these, let's say, you got stop orders. Stop orders like that piled up here on these levels. So as price runs through those, they are forced to buy to cover. When they're forced to buy to cover, and you still got bears trying to get out from all of this stuff, right? They're buying to cover as well. And you got all the buyers that are buying this stuff because they know that bears are stuck, right? And you got long-term investors or whoever that reverse this whole train. Okay, they're buying for the long term. Right? Then you got all these stops blowing out. They're buying to cover. This thing rockets off. It's called a short squeeze. So it breaks out of resistance right here. Okay? And this whole thing, that whole thing is called a bear trap right there. Okay, and it happens every single day. It's called a bear trap. And the other side of it is a bull trap, and that happens as well. But that happens when the market rallies higher and then reverses. And so it's just, it all has to do with the slippage of the big, the big size traders. Okay, they're trying to basically turn that huge big rig around now in the middle of town, and it's just not so easy. Okay, and so because they're so stuck, right? Basically these markets, between bids and offers, it's a very narrow street, okay? And so they got to work this thing. They got to work this deal as best they can. And while they're stuck in there, you on your motorcycle or your bicycle, your BMX stunt huffy or whatever, you're running stunts here and you're profiting. You're doing flips in the air and whatever you do on those things. And they're all stuck like Chuck. And then finally they get out and you're running with the money. So, way to be a help, do your country a favor, and now go buy some property or a real business or something. Okay. Size trap. It's a size trap. Those are the size traders. Size trader is somebody that's in there with like 50,000, hundreds of thousands, millions of dollars, and there's whole floors of these people in these cities. And then there's, individual traders all spread out around the world and so on and so forth. It's not just in America either. Okay? So, and then they get trapped in those narrow streets at those turnarounds, and that's where you take advantage of them. Check for hot spots on the daily charts besides just the 5-minute charts. So daily charts is your day charts, right? Charts all the day durations, day candlesticks, not just 5-minute candlesticks. When major levels are being approached on the daily charts, the volume is going to be much more than normal. So for instance, if you've got major resistance or major support on your daily chart, okay, when market price is approaching those levels, okay, there's going to be a lot of people that are thinking the other way. They're going to, I mean, if it's support, there's going to be a lot of institutions and so forth that are thinking, yeah, I want to buy this. I want to buy this because it's not going to get any lower, I don't think. And so they will just start scooping it up with both hands. They'll be backing up the truck and just loading everything in. So you'll just see all kinds of extra volume. But if they aren't powerful enough compared to the opposition on the other side, okay, then they're going to be dumping just as much and more. And so all of this trading means tons of volume, okay? And so that's what you got to be expecting, and you got to be trading according to that. With enough experience, you'll know what to do. More volume, more volatility, better for the savvy trader. For the learners, just watch this stuff and observe it. I'm telling you now, you can expect it when you get to those levels. Another level is the 200-day moving average, and so forth. They are the hot spots. Let's continue with number 11. When major levels are being approached on the daily charts, the volume is going to be much more than normal. The hot spots include major support level, resistance level, major support and resistance levels on the daily charts, mind you, 200-day moving average. So that's one of those indicators. The 200-day moving average is the biggie. Basically, it means that if price goes below the 200-day moving average, it's probably a bear market if it doesn't come right back up. Basically, it's just a universal line in the sand. Everybody in the meeting knows that. So just expect behavior to act according to it. If price never breaks below it and then stays below it, basically you're in a bull market still. Bull markets last about 8 years on average. Bear markets last about 2 years on average. Oh, and bull markets travel a lot slower than bear markets. There's also volume profile nodes. I'm saying here, and volume profile nodes excluding overnight inventory on the Globex exchange. So volume profile means that rather than the daily chart having volume bars below each day or volume bars below each 5-minute bar on a 5-minute chart, there are prices on the sides of your chart, and the volume that stems off of those prices is called volume profile. Okay, and they form nodes. So at some prices the volume was much higher. At other prices the volume was not as high. And wherever those nodes stick out, well, those are called nodes. And the main one is called the point of control, or POC. So that just means that it's the main one. It's the highest point of volume on that market profile. So you need to know that nomenclature so that when you're out there and you're learning on other people's videos and you also are trading on your own, then you recognize that these nodes and that point of control are important to know, because you're going to see reversals, you're going to see bounces, you're going to see higher than normal volume. You might also see ranges either at those nodes, over the, above and below those nodes, over and over, ranging up and down over that thing because there's balance there, or between those nodes, from one node to the other node. And you can see this taking place on the daily charts, and you can see these taking place on ranges on the daily charts, and you can see these taking place on the intraday charts, which is your 5-minute, your 30-minute, your hour chart. And I say excluding the overnight inventory on the Globex exchange. So if you're dealing with NASDAQ and S&P and any other kind of stock index futures, okay, don't consider the overnight, because that trading is not pertinent to serious investing. Okay, and what you're trying to do is you're trying to determine what are the long-term institutional investors foreseeing about the market. So that's your kind of like your news source. The overnight is basically the stuff that happens after and before the regular session hours. Okay, all that stuff happens on the Globex exchange, and it doesn't happen on these ordinary exchanges like the CME and so forth, the NYSE, etc., etc. And so that overnight stuff is basically like small investors, haphazard investors, Asian investors, European investors, but still, if they're serious enough, then they wait for the open of the American, session. They don't do it overnight because the prices aren't as cheap, and it's a much more illiquid market. It's like your garbage hours. That's not going to count on your equities. But when you're doing oil and you're doing the euro, okay, now oil's a very worldwide market. Equities, American stocks, that's equities, that's a very American market. So oil and euro, like the euro futures, those can see a lot of serious investing. In fact, I see it all the time. Serious investing overnight, hours before the actual open of the session. Okay, and so perhaps include the Globex volume on your volume profile chart or market profile chart for those two markets or markets like that. But as far as U.S. equities, don't, because they are not foreign, they are domestic or pertaining to just one region, and so you just want to read the serious investors that pertain to that region. You don't want to read the investors outside of that region if it's not important to any investors outside of that region. Oil pertains to the whole world, right? It's a world of investors. The industries are all around the world, right? The euro, same thing. It's not the biggest currency, but it is the second biggest currency. And Europe is trading in the mornings before our markets open. And so, therefore, overnight trading pertains to the euro, right? So, therefore, you would include that on your market profile. Number 12. If the price is almost to your price target to stop, just take it. It's never going to get there 100% of the time, and if it does anyway, the cost of executing a little bit early will more than make up for the cost of all of the trades in which market price will never make it to your price target. So now if you say, okay, I'm going to set a price target, and if price don't get there, then okay, so be it. But that's my price target. Well, here's the thing with that. A lot of times, in fact, I found most of the time that unless you set a very tight target, then price is never going to get to your target. Okay? Or it'll get there once in a while, but then you're not making anything on all the times that it never gets there. Okay. So in my experience, I set the price target way out there. Like, I put my price target at 60 ticks. Okay. And if I need to, I can draw in the price target. Sure. I can click, at any tick before 60 ticks, and now that's my price target. But I just keep it automatically on there at 60 ticks. Okay. But normally when I trade, what I'm doing is I'm just saying, all right, whatever it gives me. It gives me $50, $70 easy. Okay, that's it right there. That's enough for me. If it punches 100 or 150 to me, okay, or maybe a couple hundred, and I hadn't closed the trade yet, it just punches it to me so fast. Okay, now that's my target. Okay, so it's more of a time frame thing to me, right? Before it can start to think about taking the money back, I've already closed the trade. I don't really have a price target. That's just how I work, and it's basically the punch through the breakout, right? The breakout above resistance, or the breakout through support, and then the time that it takes to punch money into the account of mine, and then start talking about, maybe thinking about taking it back. Well, as soon as it starts looking like it might, it starts wiggling up and down, looking like it wants to take money back, I'm done. And then I look for the next trade. That's how I do it. But in regards to those price targets, okay, sometimes you might just ought to consider, closing the trade a couple of ticks early, or 4 ticks, 1 tick, or whatever's relative to the situation. One of the sayings is, don't be a dick for a tick. Okay, because why? What does that mean? It means that if you're just rigid about this target thing, okay, the chances are you're not going to ever reach your target. You're going to have to compromise a little bit. And if you've got it within reason, close to that area, that price, take it and grab it and run before it goes back on you, because much of the time it's going to go back on you. Okay, so, but you'll figure that out. But just take it from me, that is part of the problems out there in this kind of business. Okay, and in fact, in other businesses like grocery stores and any kind of retail stores, etc., it's the same thing. Selling used cars, selling used anything, it's the same thing. So you've got a price. Somebody comes close to it, sure, take it. Because you don't want to get stuck. You don't want to get stuck with the thing far below what you were asking for. Otherwise, you start losing profits. You don't just lose profits, right? You start costing yourself. You don't want to pay for these trades. Trust me. You'll have a miserable life. It'll be a bad day. So anyway, that is it for this long video, and good luck.